So let's talk about the individual sections of a Schedule C. The first part here is just basic information, the name of the sole proprietor and their social security, the principal business or profession. So if you're a CPA, you would put CPA or accounting here. And then there's a code you have to select. I believe it's called the NAICS code. Okay, so it's called the NAICS codes. And there's just a bunch of them. And all you have to do is try and find the appropriate code. And this just allows the IRS to categorize you into a certain section. So it has an idea of how many people of each area are being reported. So you can see down here under professional and scientific services, there's 2.2 million companies that are being reported under it. And you go even further. You don't just stop with the 54 number here. We got to keep going down and down. So I'm a CPA, so I would start here by looking under the professional and scientific services. And here you go. You can see there's actually a specific code for offices of CPA, and you can see there's 73,111, and that's me, this last digit here, that's me. So maybe you're not a CPA, maybe you just prepare tax returns. So here you go, maybe you just offer payroll services. And so this is the code you would use. We've never been too accurate on trying to figure out what code we need to use. You know, if you're a direct sales person, maybe somebody who goes door to door trying to sell whatever it is, well, here you go. I would start probably just using this other direct selling establishment, and here's the code for that. So that code goes on our Schedule C, and that code, once you find out what your code is, would go in this box right here. Your business name, if you don't have another business name, you can leave it blank, but a lot of people have a business name for their business, and that goes right in here. And then if you do have an EIN number, which again, most small businesses don't have an EIN number, I highly recommend you get one. They're free. You can get them from the irs.gov website in about 5 minutes. And what that does is that precludes you from having to give your social security number out to people you work for. I think we talk about 1099s later on. And if you are supposed to get a 1099 from whatever business you're doing work for, you would have to give them your social security number unless you have an EIN number. And so that's what I prefer to do, is to get an EIN number so that when the business asks you for your social security number, you can say, here's my EIN number. Then just a few questions. Are you using the cash method or accrual method? Most small businesses are using cash. Did you materially participate? Yes. Did you start this business in 2018? This changes every year to whatever year it is. And did you file any 1099 forms? Yes or no. So that's all very simple, this part one. And then you get into income. What is your gross receipts? Any returns and allowances? Cost of goods sold equals your gross profit. So line one would be 100% of your income. And then you're allowed to subtract your returns and allowances. So if you sold $1,000 of goods, $1,000 would be here, but if somebody brought back something for $100, then you would put that in here as a negative number, and now you would have $900 here, and then you would subtract your cost of goods sold right here to get your total gross profit. And this is where we start. Once we subtract the cost of goods sold, we start with this number here, and that's where we'll start subtracting our expenses from. And then on part two, we have all of our expenses. This is where you list all of your expenses. They have some general categories that they listed here. I don't know why they picked some of these categories, but you know, depletion doesn't show up on very many tax returns at all, but it's a separate line item here. You know, I would think a cell phone or telephone would be a better line to have on here, but they don't have it on here. But you do have this other expenses here, line 27A, and that carries on to another page, which I think we see in a minute, where you can list out anything that doesn't fit in one of these categories here. I try to get my clients to use as few categories as possible. One of the things I always tell them, I say, if you need it broken down into a separate category, then do so. If you don't need it broken down into a separate category, try and combine it into one of the categories you already have. One of the big ones I see is like insurance. They'll have a separate category for general insurance, and then a separate category for property insurance, and then a separate category for workers' comp insurance, and then a separate category for health insurance. Do we need all those categories? Well, I don't know. This is a management's decision. If they need to see all those categories broken out separately, then by all means do it. But when it gets to me, I'm going to combine all those categories into insurance. And so I try to make my life as easy as possible by getting my clients to use as few categories as possible. And with computer software these days, especially QuickBooks, you can have sub-accounts. You can have a main account called insurance, and then underneath it, sub-accounts, so that they could still see all the breakdown, but then we could just group it by main accounts, and I could just see the total of insurance. So don't go overboard when you're trying to design your accounting system on categories. Keep it down to 10 or 15 categories. That's generally enough for everybody. Depreciation, that's a big one right here. That comes from another form, 4562, and we talk about depreciation later on. Again, this is where you'd buy a capital asset. We don't write it off in 1 year. We have to depreciate it and take it out over multiple years. And then the home office, there's a separate line down here, for expenses for the business use of your home. And we talk about this here in a little bit. So just know that that goes here. The reason we have to break it out separately is the home office is not allowed to increase your loss. So if you already have a loss in your business and then you want to deduct the home office, you're probably not going to be able to do it. So a home office can only reduce your profit, but cannot increase your loss. And then you get down to your bottom line, which is your net profit. And this is the magic number right here. This is where we're going to pay taxes on right here. This is the number that your bankers want to see to try and determine if they should loan you money for your business or not. And this is where me and the bankers usually butt heads, because for my clients, I want to get this number as low as possible, but bankers always want to see this number as high as possible. And that's where we have to kind of come to an agreement and meet somewhere. Another part of the Schedule C is your cost of goods sold, and it's a pretty easy one, but you do have to carry over a number from the previous year tax return, and that's your beginning inventory. So if you're just a purely service-based organization, you're not even going to use this section. I'm a CPA, I'm a service-based, so I don't even use this section at all. But if you're selling goods, then you're probably going to use this section. So we start with our beginning inventory and we add in our purchases. This is stuff you should have learned way back in fundamentals of accounting. We add in our purchases here. We add in our cost of labors to produce the product that we're selling. We add in our materials and any other costs that we might have. And then we subtract our ending of the year inventory, and that will equal our cost of goods sold. So you might just buy goods that you resell. So you're not going to have cost of labor to produce it. You're not going to have materials and supplies. You're just going to have purchases where you go out and buy your inventory and then you sell it. So you would have a beginning number, purchases minus your ending inventory is going to equal your cost of goods sold. But now let's say you're building houses. Well, now you're going to have a lot. You're going to have, you might purchase items to go in the houses, like, you know, refrigerators or things of that nature. You're going to have cost of labor to build the houses. You're going to have materials where you're buying the wood and all that good stuff to build the house. So you're going to have a lot of stuff on here. And then same thing, we subtract our ending inventory at the end of the year and we get our cost of goods sold. And now we're going to talk about your vehicles. We're just going to touch on it briefly here. We go a little bit more in depth a little later on today. You can use this section, it's part 4 of the Schedule C. You use this if you're using a vehicle in your business, and it's used to help you determine your ratio or your mileage deduction. We'll talk about these again here in just a few minutes. So as you'll see on the Schedule C, you have to list your business miles, your commuting mileage, and your other mileage, and we'll use those numbers to generate this ratio, and we'll see why here in a minute. It's mostly just informational type of data here, nothing really substantive here. And the self-employment tax. This one is the pain of all self-employed people. They hate it because it is just, they usually don't prepare for it is the problem. And you have to pay this tax if you have over $400 of self-employment income. And when you do that, you file this form SE, Schedule SE, and it helps you calculate your self-employment tax. This form is not a very complicated form. Basically what it asks for is your net income from a business. Here it's asking for your net income from your Schedule C. This is from your net income from your Schedule F. And then what you do is you multiply it by 92.35. And that's just to get you down to where if you would have deducted half of the self-employment expenses, it'll get you to that number. And then you multiply that number by 15.3%. And that is your self-employment tax. So as a general rule of thumb, I don't worry about this multiplying it by 92%. I like to be conservative with my clients, which means I overestimate their taxes. So we take their net profit and I say multiply that by 15.3%, and that is going to be your self-employment tax. Why is it 15.3%? Well, right here, you can see it's broken down into 2 numbers. 12.4% for Social Security, and 2.9% for Medicare. And it's been this rate for a long time. Ever since I was in school, it was this rate. So being self-employed, it does cost you a little bit more in taxes, but in reality, it only costs you 7.65% more to be self-employed than it does to be an employee. And if you're good at math, you probably can tell 7.65% is exactly half of 15.3%. You are already paying these. If you're working for somebody right now as an employee, you are already paying these, but you're not paying both parts of it. You pay half of it. So every paycheck you get, they take out 6.2% of your pay for Social Security, and they take out 1.45% for Medicare. What you're not seeing right now is your employer is matching these two items. So when they withhold 6.2% from your check, they match it by 6.2%. And so now you have 12.4% paid in for Social Security. Same thing for Medicare. They withhold 1.45% from you, and they pay 1.45% from their pocket. And so that's how we get this 15.3%. When you're self-employed, there's nobody to match your withholdings, and so you have to pay it yourself. And so that's where this becomes a problem. Social Security portion does cap out when you start hitting the profits of this much here for 2019, 132,000. So it's a pretty big step to get to where your Social Security caps out. And this number jumps up every year, and it's getting a little bit more aggressive on how it jumps up because Social Security is having a little funding issues. So that does go up. So the best thing to do is remember this number. And also you got to remember, you've got to pay income tax. This is just self-employment tax. You still have income tax on top of your self-employment tax. So the average rate right now is between 12 and 15% of income tax and 15.3% of self-employment tax. So you could end up paying 30% of your profits for taxes. Let's say you make $10,000 doing your sole proprietor business. Well, now you got to pay 15% of income tax, 15.3% of self-employment tax. So you can see roughly your taxes are going to be $3,000 just on that $10,000 of profit. So that's why I call it the bane of the sole proprietor's existence, because it really hurts unless you're prepared for this. I see a lot of my clients, they end up working the current year to pay last year's taxes. You cannot do that. That will drive you into the ground. You've got to work this year to pay this year's taxes. Don't be working this year to pay last year's taxes. Work this year to pay this year's taxes, and that requires planning and estimating. All right, so next we're going to talk about inventory and calculating your cost of goods sold using some really crazy stuff that the IRS has given us. So see you next time.